Welcome to Longview. In episode 1, we broke down how international business owners voluntarily adopted the US dollar as the financial Esperanto of global trade, just to slash transaction friction. In this episode, we're shifting our lens from private enterprise all the way up to the apex of state finance, central banks. You've probably noticed a recurring trend in the financial media. Every few months, commentators and analysts issue dire warnings predicting that the dollar is doomed and the US debt market is about to implode. But if you pull the official data from the International Monetary Fund, IMF, you'll see a far more honest reality. The US dollar still accounts for roughly 58% of all allocated global foreign exchange reserves, maintaining its crown as the world's undisputed primary reserve asset. And within those dollar holdings, US Treasury securities make up the structural backbone of central bank balance sheets worldwide. Which begs an obvious question. Are these central bank governors and chief economists suffering from collective amnesia? Do they not read the news? Are they blind to rampant money printing and skyrocketing US national debt? Why do they publicly voice concerns over dollar risk in conference halls, while behind closed doors, their actual trading desks quietly pack state balance sheets with greenbacks? What are they really optimizing for? To understand this behavior, let's use a bit of real-world logic. Imagine you're traveling to the North Pole tomorrow. You wouldn't pack your pockets with regional vouchers or hyper-local script that only work in a tiny southern village, right? You wouldn't even want to carry niche national currencies because you know deep down that if an emergency strikes in the freezing wilderness and you need to buy supplies, locals won't accept obscure tender. What you want in your pocket is the ultimate, universally recognized, hard currency that no one on earth turns down. Central banks face the exact same predicament. Retail depositors save money to consume, to buy a car today or a house tomorrow. Central banks, however, do not hoard foreign exchange reserves for consumption. In official institutional design, FX reserves have a brutal, unvarnished definition. They are not a nation's pocket money. They are the sovereign economy's structural crash pad, the ultimate financial defense weapon built to withstand global market tsunamis. Today, we're going to examine why, in the eyes of central banks worldwide, the US dollar remains the premier structural shock absorber against external financial crisis. To understand what FX reserves actually do, we have to step into a time machine back to 1997 and reconstruct one of the most brutal battles in modern financial history, the Asian financial crisis. Back in 1997, sudden shifts in international capital flows severely exacerbated structural vulnerabilities across Southeast Asia, including fixed exchange rate regimes, fragile external debt profiles, and undercapitalized banking systems. Spearheaded by Wall Street speculative capital, most famously George Soros' quantum fund, short sellers targeted Southeast Asian economies, sitting on inflated asset bubbles. Their first target, Thailand. The short sellers played a completely open strategy. They borrowed massive amounts of Thai baht, dumped those baht-denominated assets onto the open market, and converted the proceeds straight into US dollars, betting heavily on a currency collapse. It was the macro equivalent of a run on an entire currency. Everyone was frantically selling baht simultaneously, driving its market value off a cliff. For the Thai government, allowing the baht to freefall meant total economic devastation. Domestic prices for imported grain, oil, and raw materials would skyrocket tenfold overnight, bringing the real economy and public livelihoods to a grinding halt. At that moment, the Bank of Thailand had no choice but to step into the arena. How do you fight back? Currency markets don't care about press releases or political speeches. They care about liquid capital. As the market dumped ocean loads of baht, the central bank had to act as the ultimate buyer of last resort. To hold the peg, the central bank was forced to deploy its foreign exchange reserves, buying up domestic currency in the open FX market to artificially prop up the exchange rate. At its core, this war of attrition boiled down to a single metric. How many US dollars did the Bank of Thailand actually have in its vault? We all know how that story ended. It was a devastating chapter in macroeconomic history. The Bank of Thailand severely overestimated its firepower. Their modest chest of US dollars was completely incinerated by speculative short sellers in a matter of days. Once their reserve cushion was drained dry, the central bank surrendered, announcing that the baht would be cut loose to float freely. That very day, the baht lost half its value. As the currency cratered, domestic corporations carrying massive USD-denominated debt saw their debt servicing costs double overnight, triggering a chain reaction collapse across both the financial sector and the real economy. The contagion rapidly burned through South Korea and Indonesia. The crisis in South Korea got so severe that citizens literally lined up around the block to donate personal gold rings and necklaces to the state so the government could convert it into US dollars to service sovereign debt. Ever since 1997, central bank governors across developing economies have suffered from collective institutional PTSD. They realize that foreign exchange reserves aren't just an accumulation of trade profits, they are a vital shock absorber against global capital flight. They learned a bloody macroeconomic truth. When panic strikes and capital flees, printing more domestic currency is utterly useless for stabilizing your exchange rate. In the heat of a crisis, the only thing that can save your sovereign economy is how much universally accepted asset reserves, meaning US dollars, you hold in your vault. From that day forward, maximizing exports, running persistent trade surpluses, and aggressively hoarding dollars as a sovereign bulletproof vest became standard operating procedure for global central banks. By official IMF definition, foreign exchange reserves are official assets held by monetary authorities that can be deployed instantly for international payments, exchange rate stabilization, and managing external shocks. If central banks know these reserves exist to preserve sovereign survival, it raises a fundamental question. Why must it be the dollar? Why not holding euros? Why not Japanese yen? Or why not just convert trade surpluses straight into physical gold bars and lock them in underground vaults? Let's address physical gold first. Gold is an undeniable long-term store of value. It carries no counterparty risk and hedges against inflation, but it has two fatal operational drawbacks. First, it yields zero interest. If you store 10 tons of gold in a vault, it remains 10 tons a century later. Not only does it pay no coupon, but you also bleed capital paying for physical security, vaults, and insurance. Second, and more critically, while gold stores value long-term, its operational settlement friction makes it far too cumbersome for short-term, large-scale international payments and emergency liquidity management compared to electronically traded financial assets. When your FX market faces an active run and you need tens of billions of dollars instantly to put out the fire, you can't scramble cargo planes loaded with tons of gold bullion and go hunting for international buyers on short notice. By the time your gold lands and settles, your financial system has already flatlined. So why not rely heavily on the euro or the yen? This brings us to the ultimate metric used to judge institutional asset markets, market depth and liquidity. Think of global asset markets as bodies of water. European and Japanese sovereign debt markets, while sophisticated, are functionally equivalent to Lake Geneva. The US Treasury market, by contrast, is the largest, most liquid sovereign bond market on the planet. Put simply, it's a bottomless Pacific Ocean. Total outstanding US Treasury debt exceeds $30 trillion, with daily trading volumes hitting astronomical figures. What does this bottomless depth mean for central bank managers? Suppose a central bank generates a massive $20 billion current account surplus today. If it tries to deploy that entire $20 billion into European or Japanese bond markets overnight, those smaller pools will overflow. The sheer size of the purchase would artificially spike bond prices, distorting local yields. It's the equivalent of an elephant jumping into a backyard swimming pool. The water spills out instantly. But if that same central bank deploys $20 billion into the US Treasury market, it's like pouring a cup of water into the Pacific Ocean. The market doesn't even register a ripple. Even more crucial is the exit strategy. Because of the vast scale and dense web of market makers in the US Treasury ecosystem, even during periods of extreme global stress, the market maintains dense bid-ask order books capable of absorbing massive, block-sized liquidations. In sovereign portfolio management, this ability to buy as much as you need without moving the market and sell instantly for cash without taking massive haircuts is what we call absolute liquidity. Look around the globe today, no other market offers this level of shock absorption and scale. The US Treasury market has become the ultimate financial reservoir for sovereign wealth. No other pool on Earth is big enough to hold the world's financial megafauna. Finally, let's explore one of the most counterintuitive and frankly ironic phenomena in global macroeconomics. Under normal intuition, if the US economy hits a severe wall, or if Wall Street institutions trigger a financial panic, the US dollar should plummet and global investors should run for the hills, right? Yet historical reality shows the exact opposite. Whether you look at the 2008 global financial crisis triggered by American subprime mortgages, or the March 2020 pandemic panic that triggered 4 consecutive circuit breakers on Wall Street, every time the US financial architecture comes under stress, a bizarre market panic unfolds. US equities drop, US economic activity stalls, yet global institutions and central banks aggressively dump every asset they hold just to get their hands on US dollars. Consequently, whenever crisis strikes America, the US dollar index doesn't collapse. It surges like a rocket. Why? In global macro circles, this is known as an offshore dollar shortage. This structural squeeze manifested violently during both the 2008 crisis and the 2020 market freeze. Because decades of globalization didn't just denominate international trade in greenbacks. Global corporations, non-US banks, and foreign governments also build up vast mountains of USD-denominated debt. When a global crisis erupts, risk appetite evaporates. Banks pull back liquidity, shouting, "Recall all loans, freeze credit lines." As financial plumbing locks up, non-US corporations and foreign commercial banks suddenly discover that their upcoming US dollar debt obligations are unfundable. If they can't secure physical US dollars immediately to service those liabilities, they face instant default and insolvency. At that exact moment, market participants worldwide act like stranded travelers dying of thirst. They aren't analyzing US fiscal metrics, they just know that the only liquid currency accepted to clear debt obligations right now is the US dollar. In these moments of acute panic, the Federal Reserve assumes a role far beyond that of a typical central bank. During global USD liquidity freezes, the Fed functions as the global lender of last resort. The Fed deploys a specialized mechanism known as central bank liquidity swap lines. Put simply, when the European Central Bank, Bank of Japan, or Bank of Korea face acute dollar panics, they can pledge their domestic currency as collateral to borrow massive USD cash liquidity directly from the Fed to backstop their domestic banking systems. During the 2020 market crash, the Fed rapidly expanded these swap lines, acting as the primary liquidity valve to keep the global financial system from seizing up. Picture the dynamic. As global financial markets lock up and institutions suffocate from dollar starvation, only the Fed holds the master key to the global oxygen machine. Every time the Fed steps in to stabilize a crisis, it inadvertently cements central bank reliance on the dollar standard even deeper. And with that, the core logic of episode 2 falls neatly into place. Global central banks hoard US dollars and buy US Treasuries out of cold, hard institutional rationality. They require the unmatched depth of the US Treasury market to store national wealth, and they rely on the absolute liquidity of the greenback as an insurance policy against global financial shocks. Even as the US continues to expand its balance sheet, there is currently no alternative asset market on the planet that matches the scale, depth, openness, and institutional trust of the US dollar framework. Now, if you've been following closely, a fascinating paradox might be forming in your mind. In episode 1, we established that global trade is priced and settled in dollars. In episode 2, we showed that central banks stack those trade surpluses into US Treasuries, effectively lending those dollars straight back to Washington. If that's true, shouldn't all the dollars circulating around the globe eventually get sucked back into the black hole of US sovereign debt? Why then are global markets continually flooded with a seemingly infinite supply of offshore dollars roaming the world? Here's an even crazier question. If global cross-border trade and debt settlements require tens of trillions of dollars daily, could the US physical printing presses even print cash fast enough to supply that volume? Here's a spoiler for you. The vast majority of US dollars circulating around the world today have never set foot in the United States, nor were they ever printed by the Federal Reserve. So where do these mysterious global dollars actually come from? Who is creating them in the shadowy financial plumbing? And who is the true invisible architect of the system? In our next episode, we step into the most mind-bending structural layer of this series, who actually creates the global dollar. Join us next time as we crack open the hidden vault of Eurodollars and shadow banking. This channel does not offer investment advice. We aim to polish the precise lens for observing a world in structural transition. This is Long View. If you found this deep dive valuable, hit like, subscribe, and stay rational. See you in episode 3.